Hello, ladies and gentlemen. Good evening, and welcome to the show. Glad to have you guys here on this. It's March the 22nd, Monday, and what we're going to look at tonight is we're looking at uh, a market crash is coming, guys. This is what I see coming. It's going to start on April Fool's Day or a little bit thereafter. Early April is when I'm expecting it, and this is one of the big reasons why I'm saying that this is going to happen is the banks are going to become net sellers instead of net buyers. The U.S. Fed has allowed the SLR exemption to expire. U.S. Fed allows SLR exemption to expire. Let's expand the page a little bit so you guys can see it here. U.S. Federal Reserve has decided not to extend the regulatory rule imposed during the onset of the pandemic that allowed banks to hold less capital against treasuries and other holdings. The Fed finally addressed the fate of the supplementary leverage ratio exemption on Friday, announcing it will allow the change to expire as planned on March 31st, 2021. Okay, there's $500 billion here at stake that the banks are holding in these extra capital, and they're going to have to pare that capital back. That means selling. What happens when huge amounts of different holdings that the banks have been holding are suddenly sold? This is one of the things that are coming into place come the first of next month that I expect to. Markets are over. Let's face it, guys, anyway. Markets are completely gone beyond the pale. They've never been higher, according to earnings ratios, than they are right now. Never in the history of markets. Before the crash of 1929, they were not higher than they are right now. What has buoyed these markets up to these unbelievable heights? Stimulus and monetary policy. So on one hand, you have fiscal stimulus, and on the other side of that coin, you have monetary policy. Now, back in 2008, they went heavily into monetary policy. Monetary policy itself is not that inflationary. In fact, some would argue that it's slightly deflationary. But fiscal stimulus, on the other hand, is extremely inflationary. And so I think the way they're thinking right now is they're thinking they've just pumped out huge amounts of fiscal stimulus. I'm thinking that the Fed is probably thinking to themselves that they can get away with this because it's going to be kind of like robbing Peter to pay Paul. Let the plaster fit the sore sort of thing. All this fiscal stimulus, they're thinking to themselves that inflation's going to heat up too much, and they're thinking this will cool it off. So this is the perfect time for us to get out of this supplementary leverage ratio. So they announced Friday that they will allow the change to expire as planned on March 31st, 2021. The regulatory change was introduced in the height of the pandemic and during that economic crisis we had back in March, allowing the United States banks to forego circulating their reserves and treasury holdings, both of which are deposited at the Fed. When determining the SLR, the relax of capital requirements, okay, I'll underline it, the page right here. The relax of capital requirements, allowing banks to continue lending during the recession without having to take in reserves or government bonds. Without the rule exemption, banks would have been forced to reduce their asset purchases in order to avoid reaching their leverage cap by either raising new capital, stopping buybacks, or declining new deposits, or even selling preferred stock. They're going to have to do all those things. They're going to have to sell. They're going to become net sellers come the start of this next month. Now we got something else. More. Yes, there's more. Let's take a look right here. This is the U.S. Treasury 10-year note. I'm gonna enlarge the page a little bit so you guys can see this. We're sitting today at 1.68. We were up in the 170s. But take a look at this. We were right around 1% not that long ago. January 27th, we were at 1%. And then she started climbing. And it was slow at first. It went up here and it made a little hump and then it come back down again. Now watch this. And it went up here a week or so later, and then it come back down a little bit again. And it went up and then it come back down a little bit again. And it went up and come back down a little bit again. And it went up again and come back down a little bit. Went up again, come back down a little bit. But each time, it's making higher highs. Now, because bonds work in reverse, this is actually crashing. The bonds are crashing. The yields are going up. But today, today we got the yields falling off just a little bit. And we see it right here, this little drop. But what does it always do here? For the last few months. It goes up and then it drops back. Goes up, drops back. But overall, it's going up. So what can we expect next? Right down and you see if I kind of draw a line across here, we've reached the bottom right now on these yields. They have fallen as 4 basis points they've fallen. I think that's as much as they're going to go. How much do you guys want to bet that the yields aren't going to rise in the next few days? I'm betting they are. Then they'll drop back off again like they normally do, right? What it's setting up for is, if we pan out this timing here just a little bit, and how much we got till the end of the month, we got like a week, right, before this SLR leverage ratio comes due the 1st of April, when the banks are going to become net sellers. And if we take a look at this bond yield chart, we see this little drop off, we'll have one more little go back up again. It's probably going to go up to about 1.75 or 1.78. Make the market really nervous. Then at the end of the month, it'll drop back down a little bit again. It'll drop back down to about 1.7. Everybody will breathe a sigh of relief, They'll wipe the sweat off of their brow. But what's it going to do again then after that? It's going to bounce back up unless the Fed does something. And the Fed's not really out to do anything on this right now. They don't want to put in yield curve control right now. They see the economy heating up too much. And they're thinking to themselves, hey, let's get away with letting the yields rise as much as we can, as long as there's no crash or nothing crazy happens. Let's see how far we can get away with this. You know what they remind me of? There's a Seinfeld episode years ago, where I think it was George driving along with Kramer, in this new car, and they were going someplace. And the car went down and got on empty, And Kramer was going along and he was all excited. He was like, look, the car's empty. How much further can we go? And he was so much excited on how much further can we go on this empty tank. And he kept going and going and going. And it was like some sort of game he was playing where he could see how far he could go on empty, That's what the Fed's doing right now. They're seeing how far they can let these treasury yields go higher and higher. It's almost like a game for them. And see what they can get away with. Because they want to cool inflation down a little bit. And how do you cool down inflation? Of course, let yields rise. I mean, this is very obvious. If we go over to Erdogan in Turkey right now, they just fired some guy that worked in a high-up official, within the financial department of Turkey, They fired him because he was raising yields. But why was he raising yields? He was raising yields because he wanted to try to stem down inflation in Turkey. So they fired him. As soon as they fired him, the Turkish lira fell by 8% the very next day. Why did the Turkish lira fall by 8%? It fell by 8% because they realized that the yields aren't going to go up again. And the yields are going to stay low. High yields fight inflation. Paul Volcker proved this. High bond yields fight inflation. That's very deflationary. You know, when bond yields go up, gold goes down. Gold thrives. Gold, cryptocurrency, silver, all thrive off of inflation. So you get dropping yields, you get inflation, you know? And the thing is when inflation starts to heat up, what does the central bank do? They raise yields. And by raising yields, they can bring inflation cool off. But the problem is right now, they cannot normalize these treasury yields. Because the debt outstanding so big, they wouldn't be able to service the debt. So right now, they're in this thing where they want to see how high it can go, you know? Let's see what we can get away with. Let these yields rise a little bit, you know? Cool off this inflation. Cool off the expectations of inflation. But what's it going to do is come the first of this month, when the banks become net sellers again, and we see these yields pop at the same time early next month, probably going to pop up to, I don't know, they might pop up to 1.8 on the US 10-year. Boom, it's going to hit the markets all at once. When it comes, it's going to hit the markets all at once because the markets are over leveraged. And I don't know what it'll take, but there's no floor here to these markets. If they start to fall, investors are going to panic. And they're going to try to take profits off the table. There's no buyers there. It could fall. Nobody's going to catch a falling knife in this. Not when they get scared. So how far could it fall? I mean, it could fall really fast because we're in the age of modern computer technical trading and everything. And yeah, they can stop the markets. But there's no bottom. Well, I'm going to progress a little bit further past this market crash I see coming in early April. And this is where you guys got to stay strong, because when the market starts to crash, and I'm expecting it to, and I'm calling for it tonight, a crash in the markets in April. When that starts to happen, stay strong. If you're holding cryptocurrencies, gold, silver, it'd be a good idea to try to stay strong and hold through, because I'm going to tell you what's going to happen. I think these markets are going to fall out of bed to the point it's going to make the Federal Reserve, let's just put it this way, they're going to have to send their clothing out for a laundry change, because their clothing is going to be wet. It's going to scare them that bad. And then I think they're going to move into action. And the action's going to come quick. And I think it's going to come in the form of yield curve control. And also, they're going to have to try to stabilize the markets. And when they do that, things are going to turn around again. Big time. So, you know, there's going to be people out there make a lot of money off of this. If they can figure out where the bottom is and try to buy in the bottom just before the Fed reacts and implements probably yield curve control at that point in time. But they're going to push this. They're going to keep pushing this envelope on these treasury yields until they're forced to go for yield curve control. And they're going to see what they can get away with. So there, guys, I'm calling for it. I don't often really try to put a call on a market crash, but these two things coming together. The treasury yield starting to go up just a little bit too high, too fast, in conjunction with the SLR expiring and the banks becoming net sellers into the marketplace. It could trigger a panic in the markets. And we're going to have to wait and see. I haven't missed too many calls over the years that I've been, over the many years that I've been working on this and working in finance here and working on my two channels, put a lot of research into this, and I don't make too many big calls like this, but this is a big call I'm making tonight. I think these two things are going to come together. Yes, we do have a lot of money pouring into the system, but we're talking $500 billion here that the banks could unload. We're talking an over-leveraged market, and we're talking treasury yields rising. Wow, guys, this has been an awful turbulent year, and I don't think it's over yet. We might be get your popcorn, and we'll catch you guys in the very next show. Bye bye.